want to begin by asking you about the Fed decision that came out last night. I mean, overall, if we look at it, it was pretty much a non-event. No rate cut, no hawkish pivot. Rather, they sounded more dovish with quantitative tightening. But considering how we have seen, the narrative entirely shift and the commentary from Fed shift, given the data that came out later, inflation and macroeconomic data, are you really, do you really believe that there will be no rate hike as was suggested by Mr. Powell, and the next course of action is perhaps a rate cut? And how many rate cuts are you now pricing in, and when will they eventually start?
Hi, Suyash. Good morning. Thank you for having me. So I think from the last 3 months or so, we have been in the camp of no rate cut in this calendar year, at least till elections, which are due in November. I'm talking about the US elections. The reason for that is because of this Red Sea issue, the inflation has again reared its head. Already we are seeing that the costs have gone up by 2-3x. It is taking more time, also 2-3 weeks more to actually deliver because the ships have to take a new route. On top of that, I think the commodity inflation has also picked up with the rise in copper and other base metals. Crude has also stayed broadly in range, but it has not really come down. In fact, if you look at the last 4 months, year to date, it is up about 20%. Given how the inflation has panned up, and we don't see a particular reason why that would come down immediately in the next 3-4 months. My sense is that Fed has also got hold onto it, so that's why they don't want to commit to a rate hike as of yet, because the inflation is not out of control. But at the same time, the rate cuts are definitely off the table. My sense is the rate cut would probably happen in December meeting only after the elections, and they want to keep the options open. That's why you saw that a dovish kind of pivot, that they don't want to hike, but they'll keep a tab on the unemployment and the inflation figures.
All right, and I mean the big question, at least for us, is what will RBI do next? I mean, we are in this Goldilocks sort of a situation. Amit, the growth has been solid. The inflation has moderated nicely. So RBI perhaps could be tempted to cut interest rates, but then again, cutting rates would further eat away from the spread between the bond yields here and in the US, which may again, reduce attractiveness for our bonds. They wouldn't want to do that, right? Just ahead of the inclusion in global bond indices. What is your sense of things? What is RBI going to do next?
I agree. My sense is that RBI will also remain on a status quo as of now. There is a very big event of global bond indices inclusion of India due in June. Then you have a small matter of elections and budget as well. So they want to see the new projections coming up in the budget. And on top of that, they don't want the spread to become too much with the US bond yields and the Indian bond yields. They also want to see the how the monsoon pans out, even though we expect La Nina to come now by July end or August starting. So my sense is they'll also stay on hold for at least till October, and then maybe closer to the festive season, they'll take a call whether to move a little ahead of Fed curve and start doing rate cuts before the Fed actually does. But I think till for the next two meeting in June and August, they'll probably remain on hold.
All right. But we'll shift focus, and we'll shift focus to the equity markets. And something very interesting happened in April. India outperformed the US, the Wall Street, and they were down by about 4% in the month of April. Nifty was up about 0.7%. Nifty Bank did even better. It was up about 4%. I mean, given that we have seen sustained FII outflow, do you think that this is only a one-off, and again US markets will continue to do well because again the situation in the Middle East, the geopolitical tensions still remain, and US again is considered a safe haven as far as equities are concerned?
Yeah, I think 1 month really doesn't make a trend. If you look at year to date from January till April, then US is already outperforming even India or many of the other emerging markets. I don't think that is a big of a problem as of now. I think India is sort of in a situation where people are pouring in money, thinking that there are events ahead, whether it is elections or the budget. So we will keep this momentum going, though we could be sideways in a lot of sectors and a lot of stocks. As far as this FI outflows is concerned, given how the US bond yields are there now at 4.6, 4.7, there is clear indication about taking out money from the equities and put more in the bond market. In fact, if you look at India outflows from the FI, then the last month itself there were about 8,500 crores of outflows from the equity market, but the debt market in India got about 23,000 crores of debt inflows. So I think it's a very clearly asset allocation call where they want to remove some money from the equity allocation and put it into the debt allocation. So I don't think the money is going out on a overall basis, but it's a more of a shift from equity to debt for the FIs.
All right, money is not flowing out. It's a shift from equity to debt. But also wanted to get your view on oil prices. I mean, they have fallen sharply in the last couple of sessions. When we were on a break, oil prices have receded by about 5%. We are currently, Brent crude is currently below $84 a barrel. I mean, yes, the inventories and the production in the US, it's on the rise. There is a ceasefire agreement in the Middle East as well. But the war is not really over. I mean, what are you making of the sharp fall in oil prices? My sense is that it's a technical correction because Brent crude was hovering in that range of about $87 a barrel to about $91, $92 a barrel. And since we broke below that, we saw some bit of an unwinding. What's your sense, sir?
I think it's more of a technical correction. Usually traders take positions ahead of FOMC meeting, and then there is a sort of position squaring happening. If you look at a slightly longer picture, let's say 6 months, crude is about 7% down. And if you look at the last 1 month, then it's about 10% down. We had this Gaza kind of situation in October, and then we had this new geopolitical situation in early April. And despite that, crude has remained broadly, sort of a $10 range between 75 and 85. So I don't think, given how the demand is panning out, there is a case of either a very bullish case or a very bearish case. It's more of a sideways case. Most of the projections, whether if you take the RBI, which is taking into account about $82 per barrel average in their inflation projections, or even if you take, let's say, Fed projections, which are about 80, 81 dollars in their quarterly projections. So I think broadly everybody is expecting crude to remain in this. The joker in the back could be some sort of escalation in the geopolitical situations. But given the election seasons, I believe that can be controlled by the politicians, and we will see not very big sustainable moves in crude either in either direction, whether
Hmm.
it's down or up, and we could have a sideways kind of a movement.
All right.
Historically, this market is a little bullish, so we have to wait and see how it pans out over the next 3 months.
We are in the middle of the earnings season and we have some big ones lined up today. Adani Twins, Adani Enterprises, Adani Ports. We also have Coal India, Federal Bank, Dabur. But, Amit, I'll come to you. Let's begin with the biggest one of them all, Coal India. The numbers are due today. What is the street expecting?
It's looking good. There were fears that the e-auction prices had cooled off, but the volumes have well compensated for the reduction in the auction prices, and they have remained firm for the last 4 months. Revenue is expected to rise a modest 8.7%. Net profits are expected to rise as much as 27% year on year. EBITDA as much as over 45% year on year. I have a question for Mr. Amit Gupta. So, Coal India today is slightly in the negative this morning, even though it has given returns of over 90% over the last 1 year. What do you make of Coal India right now?
Right. So I think the stock price has recently corrected because of the fears of this e-auction prices cooling off. So the logical conclusion is that the rise in e-auction volume can be compensated for the fall in the e-auction prices, and as a result, the profit which is coming from these e-auction volumes that has remained pretty much constant over the last quarter or so, which is a sort of a positive. But the upside estimates, in terms of incentives, that is sort of capped at around 7,000 crores. The manpower cost has remained quite stable. So even though the coal offtake has been higher by about 25-26%, and the input costs have been also a little higher, but the IPTA could actually decrease by about 6-7% quarter on quarter. So overall, I think I'm not too negative on the earnings. My sense is that whatever they have lost in the e-auction prices, they can make up with the higher overall coal takeoff.
So, post elections with a new budget, do you expect a spike in volumes with new infrastructure projects basically taking off with the new government, whichever it is?
So usually, the period in or before the budget, even 3 months after the budget or after the elections, that is usually a very slow period, because government takes its time. New government comes in, new portfolio ministry comes in, and then only the ordering starts. So I think the first half of FY25, that will be a little slow. But as we head towards October, November, during the festive season, then we'll see a little bit more pickup in the ordering. But I think the first half is going to be slower. A lot of companies, not just Coal India, but a lot of other infrastructure companies which we are tracking, where we have recommended to our clients, there also we are getting the same commentary from the company management, that H1 is going to be really slow, and the ordering will pick up only in H2.
All right, and before we let you go, sir, what's your overall assessment of the Q4 performance so far from India Inc? I mean, it looks like it has been a mixed bag. IT, except for TCS, I mean, the commentary is still over there, at least the guidance on both revenue as well as the guidance on, the operating margin front has been slightly muted. But banks, they have done well. NIMS pressure, which was expected to, increase substantially in this quarter, that has not really showed up for at least your major banks, HDFC and ICICI Bank comes to mind. What's your take on the Q4 performance so far?
I think we have been maintaining this stance that compression of NIMs for the banks, that will not happen in just one quarter. I think it's a trend which will stay for at least next couple of quarters, and we will see that. In fact, if you look at the HDFC Bank hasn't really gone anywhere. Kotak is also now down 20% or so. ICICI Bank has also been flat. The only private bank which has gone up is Axis Bank. So I think there is clear pressures among the lending institutions, and given how their deposits are currently moving, I expect that this NIM pressure will continue at least over the next couple of quarters. As far as the market overall is concerned, or the quarterly earnings is concerned, I think there are some risks like the premium valuations and sensitivity to rate hikes if it happens. India is an attractive long-term opportunity. The medium and long-term outlook is still very robust. But I think some sort of a time correction which can happen, that will be good for the markets. So far, I think around 200 companies have declared their results. So concluding the overall earning trajectories will be too early. But what we have seen is that there is a rolling recovery across many of the sectors. There is a rolling consolidation which is happening. The benefit which was there in the last year because of low crude prices, because of higher crude prices or higher commodity prices, that is sort of even out a little bit. But the management commentaries was, suggesting a very mixed picture. There was a strong performance in the non-lending part of the financials and the autos. But again, at the same time, technology companies are facing challenges in expanding sales or even managing their high costs. So far it's been a lot of a mixed bag. I think probably in the next couple of weeks we'll have more idea how things are panning out from an overall perspective.